The shooting star candlestick pattern is one of the most powerful and psychologically rich reversal signals in technical analysis, widely used by traders in the United States across stocks, Forex, crypto, and indices. This pattern appears after an uptrend and signals potential weakness in bullish momentum, often warning traders that a reversal or at least a pullback may be near. To truly understand the shooting star, it is important to go beyond its simple shape and dive into the mindset of market participants, because candlesticks are not just lines and bodies on a chart. They are visual representations of fear, greed, hope, and disappointment unfolding in real time. A shooting star candle forms when price opens, pushes strongly higher during the session, and then sharply reverses, closing near the opening price or even lower. The candle has a small real body near the bottom and a long upper wick, often at least 2 or 3 times the size of the body. This long upper shadow tells a critical story. It shows that buyers were initially in full control, pushing prices higher with confidence. However, at higher levels, sellers entered aggressively, overwhelming the buyers and forcing price back down before the close. This sudden shift in control is what makes the shooting star such a meaningful signal. In the context of an uptrend, this pattern reflects exhaustion. Bulls who were previously confident start to take profits, while new buyers hesitate to enter at elevated prices. At the same time, sellers see an opportunity to step in, believing the market may be overextended. The result is a candle that visually looks like a star falling from the sky, which is exactly how the pattern got its name. It symbolizes the moment when bullish dominance begins to fade. However, the shooting star should never be traded in isolation. Professional traders in the USA understand that context is everything. A shooting star that appears after a strong, extended rally is far more significant than one that forms in a sideways or choppy market. When price has been climbing steadily, optimism becomes widespread. Retail traders chase price higher, headlines turn bullish, and social media sentiment often becomes euphoric. When a shooting star forms in this environment, it acts as a warning sign that smart money may be distributing positions to late buyers. Volume plays a crucial role in confirming the shooting star pattern. If the candle forms with higher than average volume, it suggests strong participation from sellers. This means the rejection at higher prices was not random or weak, but rather driven by institutional or large traders. In contrast, a shooting star with very low volume may indicate hesitation rather than conviction, making it a weaker signal. Another important aspect is the location of the shooting star relative to key technical levels. When this pattern forms near a major resistance level, such as a previous high, a psychological round number, or a Fibonacci retracement level, its reliability increases significantly. Resistance zones are areas where selling pressure naturally accumulates, and a shooting star at such levels often confirms that sellers are defending that zone aggressively. Many traders confuse the shooting star with similar-looking candles, such as the inverted hammer. While the shape may look similar, the context is completely different. A shooting star appears after an uptrend and signals potential bearish reversal, while an inverted hammer appears after a downtrend and suggests a possible bullish reversal. Understanding this distinction is critical because trading the same candle shape without considering trend direction can lead to costly mistakes. Confirmation is another key principle when trading the shooting star. Conservative traders usually wait for the next candle to confirm the reversal. This confirmation often comes in the form of a bearish candle that closes below the shooting star's body or low. This follow-through price action indicates that sellers have maintained control beyond a single session, increasing the probability of a successful trade. Aggressive traders may enter immediately after the shooting star closes, but this approach carries higher risk and requires strict risk management. Risk management is essential when trading shooting star patterns, especially in volatile markets like crypto or high-growth U.S. stocks. The most common stop-loss placement is above the high of the shooting star. This makes logical sense because if price breaks above the upper wick, it invalidates the bearish rejection and suggests buyers have regained control. Profit targets can be set at nearby support levels, moving averages, or based on a favorable risk-to-reward ratio, such as 1:2 or 1:3. Psychologically, the shooting star reflects a shift in sentiment. Early in the session, buyers feel confident and optimistic. They push price higher, believing the trend will continue. As price reaches higher levels, fear begins to creep in. Some traders who bought earlier decide to lock in profits. Others, seeing price struggle to move higher, start to sell aggressively. By the close, optimism has turned into uncertainty, and sometimes even panic for late buyers who entered near the highs. This emotional transition is what gives the shooting star its predictive power. In U.S. markets, the shooting star is particularly relevant during earnings season, Federal Reserve announcements, and major economic data releases. For example, a stock may rally strongly on earnings expectations, only to form a shooting star on the day of the actual announcement. This often indicates that the good news was already priced in, and smart money is selling into strength.